July 2025 jobs report, disaster. Only 73,000 jobs added. Recession risk rising. The July jobs report has sounded the alarm bell for a U.S. economy in trouble. Is the soil drying up for new jobs? Here's a breakdown of why this data matters and why experts are scrambling to make sense of it. The numbers don't lie, but they do tell a scary story. Last month's non-farm payroll creeped up just 73,000, a limp result that fell below even modest expectations. Picture this, over 3 months. Job gains have tumbled to an average of 35,000, barely one-third of the same period last year. These figures mark a stark slowdown, with recent downward revisions for May and June jobs complicating the picture. Why does this matter? Job growth is often a trailing sign of economic storms. If hiring is sputtering this badly, it signals deeper weakness that traditional metrics might obscure. HAF, tariffs, economic hiccup, or full-blown crisis? Wilmington Trust's chief economist Luke Tilley calls the current climate a broad economic slowdown, with a 50% chance the U.S. stumbles into recession. His concern? Tariffs. While President Trump's import taxes haven't ignited inflation as feared, Tilley argues they've quietly reshaped spending habits. Consumers are footing higher costs, cutting back on big-ticket discretionary items. Think fewer vacations, delayed tech upgrades, and dented restaurant spending. Real income growth is slowing, and businesses feel the pinch, he warns. This might explain why inflation metrics haven't spiked. Spending power is being quietly drained. Rocket. A false sense of strength. On the surface, Q2's 3% GDP growth seems rosy. But look closer, and cracks emerge. First-half growth averaged a meager 1.2%, with consumer spending nearly flatlining. That Q2 bump? A temporary bounce-back from an import surge earlier in the year. A classic vacuum effect that doesn't reflect real demand. Markets might be celebrating the short-term boost, says PNC's Gus Foucher. But the labor market's recent revisions suggest deeper weakness. His take? We're likely in for sluggish growth. Not a collapse, but tariffs inject a wild card risk. If businesses and consumers pull back further, Foucher warns, reciprocation could occur, engineering a recession door. The White House versus the data. The administration remains bullish, touting President Trump's One Big Beautiful Bill Act as an economic game-changer. But Trump himself took drastic action, firing Bureau of Labor Statistics head Erica McIntyre just hours after dismissing the jobs report as faked. Meanwhile, National Economic Council Director Kevin Hassett towed a careful line, acknowledging the less momentum revealed in revisions, yet insisting there's super optimism for the second half. The disconnect between policy rhetoric and raw data has sparked heated debate. Bullseye. 2 critical reports Monday deepened recession jitters. 1. Factory orders plunged 4.8%, the worst drop since early 2024, worse than Wall Street predictions. 2. Employment Trends Index hit its lowest since October 2024, a P-shot to already fragile confidence. Housing, the next pressure point. Economist Jim Paulson frames the issue bluntly. A 7% mortgage rate in a 1% growth economy is unsustainable. These numbers scream lessons for help. Home sales continue to slump, caught between high borrowing costs and inflated prices, a collision course that's shutting out buyers. Markets, confident or in denial? The Dow rallied Monday on hopes of US-EU tariff resolutions, but the Dow still lags 1.7% over the past month. Key private bank's George Mateo warns, investors were overly optimistic, anticipating smooth sailing. But these shoes are finally dropping. Fairy changes in rate cut probabilities, jumping to 90% post-jobs report before retreating, highlight the volatility. Mateo's advice: rebalance towards safety. This isn't the time for risky bets. The big question, recession or recalibration? While most economists still don't predict an outright recession, voices like Economic Policy Institute's Josh Bivens flatly state, "This report looks like entering a recession." Moody's Mark Zandi agrees. The U.S. is perched on the recession precipice. Goldman Sachs joins in, predicting late 2025 growth to shrivel to 1%, a far cry from 2023's robust performance. Your turn. Are we sleepwalking into a recession? Proponents of optimism argue strong consumer savings and corporate resilience will buffer the hit. Critics counter that tariffs, weak payrolls, and wobbly housing form a toxic cocktail. Where do you stand? Sound off. Is this scare overblown or the canary in the coal mine? Market reactions remain mixed, but one COSA's clear. Uncertainty reigns, and every data point now holds outsized significance. As Matteo notes, it's time to tread carefully. This is no ordinary slowdown. America's labor crisis. Top analyst warns of zero workforce growth until 2030. A top Wall Street strategist drops a chilling prediction. No job growth in sight for 5 years. But here's what makes this wildly controversial. Imagine a future where America's workforce doesn't grow at all. That's not a dystopian fantasy. It's a stark warning from J.P. Morgan's top strategist, David Kelly. As the U.S. faces shrinking labor participation and an aging population, Kelly argues we're staring into a demographic abyss. It's entirely possible the next half-decade could see zero new workers entering the workforce, he told clients last week. The implications? Cataclysmic for the Fed's rate cut ambitions and startling cause for investors to rethink their portfolios. Let's break down the alarming numbers. Kelly's analysis comes fresh after July's jobs report shocked markets. Employers added just 73,000 jobs last month, way below the expected 110,000. The bigger blow, May and June numbers were slashed by 258,000 total jobs. That's not a minor revision. It's a red flag signaling major economic stalls. The labor force is shrinking surprisingly fast. The most troubling trend? Fewer Americans are even looking for work. The participation rate dropped from 62.65% to 62.22% over the past year, eating away at 1.2 million potential workers. Kelly explains almost half this plunge stems from retiring baby boomers, but adds ominously, even younger workers aged 18 to 54 are vanishing from the labor market. Here's where it gets terrifying. According to census projections, the 18 to 64 age group will shrink by 300,000 by mid-2026. If that trend continues and immigration doesn't rebound to previous levels, the standalone math spells disaster. With more retirees and possible net negative immigration, Kelly warns, we're literally running out of workers to fuel the economy. The Fed's impossible choice becomes a political firestorm. You'd think the lack of job growth would scream lower rates to the Fed. But Kelly argues the opposite. Cutting rates now could reignite inflation. Why? Because this isn't just a supply shortage. It's a structural crisis. With businesses competing for fewer workers, wages and prices could spike despite slower GDP growth. President Trump is already calling for emergency rate cuts to counteract new tariffs and stabilize markets. But Kelly slams that approach. The Fed needs to tread ice carefully. Slashing rates into this tight labor market risks inflation flare-ups, not more growth. His take? The central bank might be forced to leave rates high, even if it means the economy grows at a crawl. What this means for your money? Investors who've cashed in on decades of easy money, beware. Kelly's blunt message: don't bet on a roaring bull market or a rising economic tide. A no-growth worker pool could mean slow GDP gains and kept-at-bay rate cuts. He essentially tells the market to temper expectations. The golden era of low rates and high returns may be ending. But wait, is Kelly overreacting? Ask yourself, would stricter immigration policies permanently cap labor supply? Could increased productivity or workplace automation reverse this trend? Kelly's warnings prompt an urgent debate. Are we facing inevitable economic stagnation Or can we innovate our way out of this workforce crisis? Created with assist from Fortune's editorial team. The labor market hits a wall. What it means for you. The labor market has suddenly hit a significant stumbling block, and what this means for the economy and your job prospects could be far-reaching. But here's where it gets controversial. Is the cause purely external, or are policy decisions playing a bigger role than many realize? Edited by August 4th, 2025, 6:18 p.m. EDT, CBS News. The latest employment data for July delivered a sobering wake-up call about the U.S. economy, revealing that the job market is struggling under the pressure of ongoing uncertainty caused by fluctuating tariffs. What caught many off guard in Friday's report was not just the fact that employers hired fewer workers than analysts had predicted, but also the government's significant downward revisions to employment numbers from the previous 2 months. These revisions show that in May and June, job growth was minimal, with only around 19,000 and 14,000 jobs added, respectively, painting a picture of a labor market barely growing at all. Gregory Dacko, chief economist at EY Parthenon, summed this up by calling the employment growth paltry during that period. These job figures shed new light on how the economy is adjusting amid several sweeping changes. Businesses are wrestling with the consequences of President Trump's trade policies, including new tariffs and renegotiated trade deals. At the same time, the GOP's revised tax law is providing tax relief to many Americans, but also slashing spending on healthcare and social programs like food stamps. Interestingly, the job data echoes what the Federal Reserve's latest Beige Book reported, an overview compiled from local business leaders, which suggests that many companies are holding back on hiring until economic uncertainties clear up. Laura Ulrich, Director of Economic Research for North America at Indeed, and a former official at the Federal Reserve Bank of Richmond, expressed to CBS Money Watch that she had long anticipated a stagnation in jobs, saying, "Based on what I was hearing from a lot of employers, I kept expecting to see a stagnant jobs report at some point. And that's exactly what we got today." She further noted, "We know economies ebb and flow, but right now, it feels like we're in a flat spot." Put simply, while we aren't witnessing widespread layoffs, companies aren't aggressively hiring either. This kind of cautiousness can make it harder for long-term unemployed workers to find positions. They've been searching for work over 27 weeks at a rate 11% higher than last year, with 1.8 million people in this category last month, according to government data. However, there were still bright spots. The healthcare and social assistance sectors combined added over 73,000 jobs last month, showing sustained demand in those areas. On the other hand, industry sectors such as leisure and hospitality, transportation, construction, and even manufacturing showed little to no job growth, with the latter experiencing job losses in July. In a move that sparked widespread debate, President Trump accused the July jobs report of being altered for political purposes, and subsequently dismissed Bureau of Labor Statistics Commissioner Erica McIntyre. He called the downward revisions a major mistake, although revisions to jobs data are routine as new information comes to light, often fluctuating upwards and downwards over months. Heidi Shierholz, president of the Economic Policy Institute and former chief economist at the U.S. Department of Labor, challenged the president's claims, saying, "It's absurd to think the BLS commissioner personally manufactures these job numbers. These figures are the result of meticulous work by hundreds of economists, statisticians, and civil servants, following transparent, time-tested procedures." One of the biggest hang-ups for businesses has been the unpredictability around tariffs. Beth Hammack, president of the Federal Reserve Bank of Cleveland, shared with CBS News that many business owners from her region, covering parts of Kentucky, Ohio, Pennsylvania, and West Virginia, are hesitant to make major investments. Uncertainty has been weighing heavily on them. There's a lot of indecision about the timing and scale of investments, with many pulling back or postponing plans, Hammack explained. For example, a franchise owner mentioned opting to renovate existing stores instead of opening new ones due to these tariff-related concerns. President Trump has maintained that tariffs will reinvigorate U.S. manufacturing by encouraging companies to relocate factories back home rather than paying duties on imports. Some officials in his administration framed the disappointing job report as a short-term setback, optimistic that the new trade deals, which now cover close to 60% of the global economy, will boost American jobs in the long run. Stephen Miran, head of the White House Council of Economic Advisors, noted that previous uncertainty over tariffs and pending legislation probably led many businesses to delay hiring or investing during May and June. Now that new tariff rates are set for dozens of countries, a lot of firms see the path more clearly, he said. Meanwhile, the White House emphasized what it sees as economic successes, stating that inflation has cooled, wages have risen, unemployment remains steady, and private sector growth continues. The administration emphasized that the America First agenda prioritizes jobs for U.S. citizens over foreign-born workers, and that tariffs are generating billions of dollars in revenue to strengthen the country financially. However, a glaring concern remains in the manufacturing sector, which lost 11,000 jobs in July. Revisions for May and June further confirm a decline in this industry. This is especially striking given President Trump's promise to revive manufacturing jobs, supported by recent high-profile agreements involving companies like Johnson & Johnson and Apple to establish new factories in the U.S. Yet tariffs, especially on imported metals like steel and aluminum, have had a tangible cost impact, making production more expensive for manufacturers. Laura Ulrich highlighted that these tariffs place considerable strain on companies' profit margins, especially in sectors producing durable goods like appliances and automobiles. Scott Paul, president of the Alliance for American Manufacturing, described these latest job numbers as another example of treading water, noting the sector remains 173,000 jobs short of its peak in February 2023. He suggested that once trade policies and tariffs settle, manufacturing jobs could start to recover. But Ulrich cautioned that reshoring manufacturing jobs is a long-term endeavor. Building new factories and shifting supply chains is costly and time-consuming. She also pointed out that for many products, manufacturing overseas remains cheaper despite tariffs. Heather Long, chief economist at Navy Federal Credit Union, painted a stark picture. This isn't a healthy job market. The economy urgently needs tariff clarity. The longer this back and forth continues, the more likely it is that this weak hiring environment will degrade into layoffs. Is the surplus of uncertainty from trade turmoil holding back a vital sector of our economy? Could the promise of brought-back manufacturing jobs turn out to be more political rhetoric than reality? And with tax cuts on one hand and social spending cuts on the other, who truly benefits from these economic shifts? These are questions worth debating. What do you think? Is the sluggish job market just a temporary lull before growth resumes, or a warning sign?